Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, we're going to be talking about the housing market correction happening right now. We are seeing price cuts all over the place. So let's get into this presentation that me and my research analyst Joe Consorti put together. So right away here, we're seeing mortgage payments skyrocketing. So if you've been following my channel for any period of time, you'll know that I've been talking about this since January. If you look at this chart right here, this is the 30-year fixed rate mortgage average in the United States. And right around since January, we've seen it spike up just above 5.5%, getting almost close to 6% right here. So this is up 41.8%. So if we look at the gray line right here, this is from Redfin. You can see basically the 4-week rolling average of median asking prices. This is the mortgage payment based on those asking prices. You can see here that we started in 2020 under $1,500. You can see in 2021, it creeped up all the way to roughly $1,750, kind of stabilized right there. We continued the year in 2022 just under $1,750, and you can see what's happened since January. We are now sitting at roughly $2,336 at 5.3% according to July 24th. This is completely unsustainable for the average American homeowner because your pay didn't go up that much, that's for sure. Maybe in some rare cases it did. And not only that, the price of houses remained high, but we are seeing a correction in pricing as well as the interest rates going up. So we're talking about prices being too elevated too quickly. So if you've been following my work, you know that we talk about the Case-Shiller U.S. National Home Price Index. You can see how much it's gone up just since basically 2014, but it's really gone up since 2020, okay? This is almost like unprecedented times that we're seeing. This index basically takes a bunch of different metropolitan statistical areas. It takes the home prices in those areas and it comes up with this index. So the home price index is rising at the same pace before the great financial crisis. When prices are too elevated too quickly, demand deteriorates. That's what we're starting to see right now. Prices are being cut. Days on market is being increased. However, we are seeing mortgages and home prices both as 18-month lagging indicators. So let's get into this next slide that shows the leading indicators, okay? And what we're seeing here is demand destruction, meaning demand is going down. So this right here is the NAHB. This is the National Association of Home Builders. It's starting to show that potential home buyers are disappearing rapidly. So every time we see prospective buyers drop, okay, this home buyers index drop, we're seeing home prices correct right after. So if you look at this right here, this was basically in the early mid-90s. It happened in the mid-2000s, obviously with the great financial crisis. We reached the bottom right here. We saw a huge one in 2020, March of 2020. Everything shot back up, and now we're going back down. So with this being said, we are typically seeing home prices correct lower that next year, basically 12 to 18 months. So what are these leading indicators showing? So if we look at new home sales, that's what this chart is showing. They seem to peak 12 to 18 months before a major housing downturn or correction. So this was in the mid-2000s. If you look at the x-axis right here, this is 2005, 2006, and you can see what happened after that. If you look at early mid-2020, it peaked right here, and you can see what happened after that as well. We almost had another peak right here earlier this year, and then interest rates went up, and you can see what happened to new home sales. The other chart I want to show you are building permits. So these top out shortly after new home sales. So what are we seeing today? We can see here that in the mid-2000s, before the great financial crisis, building permits were at an all-time high, or a high for the period, I should say, and it went all the way down after the crisis. And then we're starting to see that again today, and then again, we're starting to see a little dip there as well at the end of the chart, if you can see that. Also, this is from Redfin. This is pretty interesting. Charlie Bolello literally just tweeted this morning. We had this in the slide deck before he even tweeted it. So I think we're ahead of the curve here, even in front of the best, if you will. No, I'm joking. I use a lot of Charlie's slides. He's great. So more price drops than any time since at least 2015. So this is the 4-week rolling average share of homes with sale price drops, meaning the prices have been cut, the whole point of this presentation. So you can see here in 2019, there was 5.2%. Now we've shot up all the way to 7.5%. For July 24th of 2022. So we are starting to see more and more price cuts happening. So another important chart here is a growing backlog of homes. So on the left y-axis right here, we have year-over-year change in inventory. You can see how inventory shot up all the way during the Great Financial Crisis or right before it. We hit a trough or a valley over here in 2013. This was a great time to buy a home in 2013. And then we see here on the right y-axis in red is the months of supply on the market, okay? So existing home year-over-year change in inventory is rising as less homes are selling, which we can see here. And then we have existing home sales month-over-month falling by 5.4%. So the cycle tops out prior to every housing market contraction. We saw this here before the Great Financial Crisis. We saw it here in 2011. We saw it here in 14. We saw it here in 18, late 18, early 19. This is when the market crashed. This is when feds were actually raising rates for the first time in a long time. Everything crashed, and then now we're going back up. So is this going to be the next green or teal circle, however you're seeing that on your screen? So how can you position yourself? As always, this is not a fear-mongering channel. I just give you facts and opinions. You can figure out what to do on your own. We're all big boys and big girls here. Number one is wait for the storm to pass. So according to that slide, we're seeing leading indicators point to declining home prices and mortgage rates over the next 12 to 18 months. We're going to wait until rates and prices normalize around their historical trend to buy and finance. So if you've been following my work, Joe and I think that we're going to see rates increase all the way up until Q1 of 2023. And then after that, I believe the bond market is already pricing in rate cuts after 2023. So when you buy, stay away from variable rate mortgages. These are your ARMs, your adjustable rate mortgages. This is what everyone fell into the trap of before 2008, before the Great Financial Crisis. The trap of a low starting rate will come back to haunt you if rates do rise, which I do see that happening until Q1 of 2023, most likely, just based on the implied rate. So fixed rate mortgages are your friend. I'll touch on this later. Number three is when rates do fall, you may want to consider refinancing. Some of you may have entered into that, 4, 5, 6% 30-year mortgage. Well, that's because you may have been itching to get into a home and, you're sick of renting, or for whatever reason. It could be, lifestyle, whatever the case may be. It all depends on your credit score. The higher your credit score, the lower your interest rate is going to be. So you may want to consider refinancing down the road. If you're a rock star credit score and you're an 800 plus, you're going to get better rates than someone who is a lower credit score. Your credit score is just your risk profile to the lending institution. The higher your score, the less risk you are, perceived risk you are, the lower rate you're going to get, okay? So when rates do fall, you may want to finance or refinance back at that 2 or 3% that we talked about here. So let's get into my thoughts, okay? As always, I end these videos with my thoughts. So what we're going to talk about here is stick to the basics, okay? I know this sounds like common sense and child's play, but a lot of people need a reality check. They get excited. They want to get into a house. They have a growing family, or they move for a job, or, for whatever reason, they're sick of renting. They want to, they want to own or build equity in a home. So don't buy too much houses, number one. I see so many people that, emotion takes over and facts and logic, they get thrown out the window. You can download my home affordability spreadsheet. You can get it through Patreon. You can do whatever you want. The numbers can tell you one thing, but, when you start, making it your own, kind of like taking the puppy home, you throw the dollar amount out the window. Just don't buy too much house. We're talking about big wins on this channel, cars, houses, big purchases like that. That is going to affect your financial future way more than a $3 latte or an avocado toast, okay? Number two is low interest fixed rate loans. They're a great hedge against the dollar. If you think that the dollar is going to inflate, or if you think that the dollar is going to lose its purchasing power, a 30-year fixed rate mortgage is essentially an effective bet against the dollar. How does that make sense, or why do I say that? It's also a hedge against inflation as well, because real estate has historically kept up with inflation, if not outpaced it. So say, for example, you're looking at a house. It's, for easy numbers, $500,000. You have $500,000 sitting on your kitchen table in cash. You can use that $500,000 to deploy it into investments, into things that are going to appreciate over time, or you can take that $500,000 and plop it into a house. Well, obviously, the smarter financial move would be to Put down as little as possible, or at least 20%. That's what I'm an advocate of, and avoid PMI and decrease in your housing values and stuff like that, just in case we do hit a recession here. But that's another topic for another video. I would take that 500 grand, I would put down 100 grand, 20%, and I would invest that 400,000 over time. So a 30-year mortgage is effectively a hedge or a bet against the dollar and against inflation, because you're not tying up all your $500,000 into the walls of your house with dead equity. You are deploying it elsewhere and allowing those soldiers, if you will, to make you more money elsewhere. So number 3, these cuts are coming off all-time highs. So yes, we are seeing more price cuts. Yes, we are seeing higher days on market. However, there's still a long way to go down. I think that we're more in correction territory, 10, 15%, maybe a little bit more in overinflated markets, maybe on the coasts, if you will. But we are starting to see more price cuts. However, we're seeing price cuts from all-time highs. It's not like we're seeing price cuts from, median or average home prices for your area. So still, I think there's a way to go down, but again, I guess 10, 15, 20% max, just because people still have jobs. Again, as long as people have jobs, we're not going to see 2008, we're not going to see 2007, but if we do start to see higher unemployment and we do start to see people who simply cannot service this debt, that's when the bubble truly pops. So keep that in mind. All right, guys, I hope you got value from this video. I'm building my school out, Whiteboard Finance University. We have professors for stocks, ETFs, options, real estate, macroeconomics, weekly live streams with me. I'm fully transparent in that group. This will be private and it will be a monthly fee. If you think this content is good, wait until you see what's behind the curtain in the school. It will truly be one of the best financial products out there. You have the choice of, taking a finance class or going for a finance degree that's 50, 60, 70, 80 grand, or you can start building your wealth for, it's probably going to be somewhere in the neighborhood of like 40, 50 bucks a month. It's a ridiculous value. It's probably comically underpriced, to be quite honest. So check that out in the link below, Whiteboard Finance University. It will be coming out in the next month or so. I'm just putting everything together and getting all the professors in place. Thank you so much, everybody. Have a prosperous day. Hey, so instead of me doing something dumb and funny at the end, you guys got to see this clip. I don't know how old you guys are, but I'm 34. I grew up with the Chappelle Show. Best comedy show of all time, by the way. This was an old skit from the Chappelle Show where they're talking about oil and going into the Middle East. And this basically it's dubbed over almost perfectly in this clip. So check this out, you guys.
Over the course of your career, has your husband ever made a stock purchase or sale based on information he's received from you?
What are you saying?
Over the course of your career, has your husband ever made a stock purchase or sale based on information he received from you?
No, absolutely not. Okay, thank you.
Over the course of your career, has your husband ever made
I love it.